Have you ever opened up a company's financial report and your eyes just glaze over? It looks like a giant wall of numbers. But what if I told you that inside that wall of numbers, there's actually a story, a really compelling story about that company's ambitions, its struggles, and its big wins? You just have to learn the language.
So let's get right into it. How do you actually figure out what a company is up to? What its strategy is, how healthy it really is. Well, you look at its official story, its financial statements. And trust me, these are not just some boring documents for accountants. They are a direct window into a company's brain.
And that's exactly how we're going to approach this. We're going to treat these financial statements like a storybook. Each report is a chapter, and each chapter tells us something new and important about our main character, the company. It makes the whole thing feel a lot less like homework and honestly, way more interesting. All right, so here's our game plan. First, we'll cover the basic rules of financial storytelling. Then we'll meet our character in the balance sheet chapter. After that, we'll follow the action in the income statement. Then comes the big reveal, how the chapters all connect. And finally, we'll talk about how to read between the lines. Every great story has to follow its own rules, right? There's a certain logic to the universe. Well, in the world of financial storytelling, there is one single fundamental rule that governs absolutely everything. It is the law of the land. And this is it, the accounting equation. Assets equal liabilities plus stockholders' equity. Now, it might look simple, but this little formula is the absolute bedrock of all accounting. Every transaction, every sale, every purchase has to obey this law. No exceptions. The best way to think about it is like a perfectly balanced scale. On one side, you have everything the company owns. That's its assets. And on the other side, you have all the claims against those assets. That's what it owes to others, its liabilities, plus what the owners themselves have a claim to, their equity. And that scale, it must always be perfectly balanced. Okay, one more key rule about how these stories get told. It's something called accrual accounting. All this means is that we record the story when the action happens, not necessarily when the cash changes hands. So a sale gets recorded when it's made, even if the customer pays a month later. It just gives you a much truer, more complete picture of what's really going on. So let's jump into our first chapter. This is the balance sheet. I like to call it the character profile. It doesn't tell you about the adventure the company's been on. Instead, it tells you exactly who the character is at one single moment in time. And that's the key word here, snapshot. If a balance sheet is dated December 31st, it's telling you the company's precise financial position on that one day and that one day only. It's what they owned, what they owed, and what they were worth, all frozen in time. So how do we build this snapshot? Well, it's built transaction by transaction. And remember our golden rule? The accounting equation has to stay balanced. This means that every single thing a company does financially has a dual effect. It has to touch at least two accounts to keep that scale perfectly level. Let's make this real. Say a company borrows some cash from a bank. What happens? Well, its assets go up, right? It has more cash in the bank. But at the exact same time, its liabilities also go up because now it owes that money back. See, both sides of the scale went up by the same amount. Perfectly balanced. But what if a transaction only affects one side of the scale? Good question. Let's say the company uses some of its cash to buy a new piece of equipment. In this case, one asset, cash, goes down. But another asset, equipment, goes up by the very same amount. The total value of the assets didn't change at all, so the scale, you guessed it, stays perfectly balanced. So to wrap up this chapter, the balance sheet is really just these three big categories. You've got assets, which is all the stuff the company owns. You've got liabilities, which is what it owes to everybody else. And then you have equity, which is the value that's left over for the owners. Simple as that. All right, we have met our character. Now it is time for the adventure. This is chapter 2, the income statement. And this is not a snapshot. Oh no, this is the plot. This tells the story of what happened over a whole period of time, like a quarter or an entire year. The whole purpose of the income statement is to answer one really simple question. Did the company actually make any money? It adds up all the money that came in, the revenues, and subtracts all the money that went out, the expenses, to get to that famous bottom line, net income, or a net loss. So the plot of this chapter follows a pretty straightforward formula.
You just take all the money the company earned from its day-to-day business, that's revenues, and you subtract all the costs of doing that business. Those are your expenses. And what's left over tells you if the adventure was a success or not. Now, for any company that actually sells a physical product, there's a huge plot point in their story. It's a massive expense called the cost of goods sold, or COGS for short. This is basically the direct cost of creating the stuff that you sold. And for a company that makes its own products, figuring this out is kind of like a mini adventure in itself. First, you figure out the cost of all your raw materials. Then, you add in the cost of labor and keeping the factory lights on. Next, you have to account for the stuff that's only half built. And finally, you adjust for the finished products sitting in the warehouse that you haven't sold yet. It's a process, for sure, but it's absolutely vital. Okay, so we've met the character in the balance sheet. We've followed the plot in the income statement. Now it's time for my favorite part of any story, the big reveal, the aha moment where you see how it all connects. And here's the secret. The adventure that we just read about in the income statement, it doesn't just happen in a vacuum. The outcome of that story, whether it was a profit or a loss, it directly changes our main character. Let me show you exactly how. It all starts with this one number. The very last line on the income statement, net income. A lot of people think that's the end of the story, but it's not. It's actually the bridge to the next part. And there it is, that net income number. It flows directly from the plot, right into the character profile. Specifically, it gets added to the equity section of the balance sheet in a line called retained earnings. So the profits from the company's adventure literally become a part of its net worth. The performance changes the position. That's the link. It's actually kind of beautiful. So now you get the basic story, right? But the real skill comes from learning to read between the lines. For instance, the balance sheet will tell you what a factory cost 20 years ago, but not what it's actually worth today. And an income statement might show a huge profit, but was that from selling more stuff? Or was it just from cutting corners in a way that can't possibly last? That's where the real analysis begins. You now have the key. You have the tools to unlock the stories behind the numbers. You can see if a company is building for the long haul or if it's struggling under a mountain of debt. You can spot the plot twists in its performance. The story is right there, just waiting for you to read it. So go pick a company you're interested in, open up its storybook, and ask yourself, what are you going to discover?